Today, failure to launch as tech drives markets lower. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, after the deep falls last Friday, following Powell's hawkish comments, a sea of red in tech stocks kept markets muted on Monday as the prospect of higher for longer interest rates weighed on sentiment. Actually, I think investors are finally waking up to the reality that rates will remain high even as recession risks grow, so are definitely in risk-off mode at the moment. In fact, join me tonight on my live show with Damien Klassen at 8 p.m. Sydney time, where we can discuss this in more detail and you can ask a question live. Federal Reserve Chair Jerome Powell said at the Jackson Hole Symposium on Friday that the Fed would raise rates as high as needed to restrict growth and keep them there for some time to bring down inflation, which is running well above its 2% target. With the Fed's September meeting just weeks away, incoming economic data, including the fresh jobs and inflation numbers, will likely sway the Fed's decision to hike rates by either 0.5 or 0.75% next month. In fact, Fed funds futures are pricing in as much as a 73% chance the Fed will hike by 75 basis points, and rates peaking at somewhere between 3.75% and 4%, and they expect the Fed funds rate to end the year at around 3.7%. Much, of course, will depend on what US August payroll figures look like this Friday. Analysts are looking for a moderate rise of 285,000 following the July's blockbuster 528,000 gain. So the Dow Jones Industrial Average slipped 0.57%. The Nasdaq was down 1.02% and the S&P 500 fell 0.65%. That's the lowest in a month after a day of choppy trading. In fact, world stocks were hammered on Monday as the growing risks of more aggressive US and European interest rate hikes inflicted more pain on bond markets and pushed the dollar to a new 20-year high as those recession fears mount. European stocks fell around 0.8% for their lowest over 5 weeks, and Japan's Nikkei slid 2.7%. London markets, though, were closed for a holiday, while MSCI's World Equity Index fell 1% to a one-month low. The 2-year US yield surged to a high of around 3.49%. That's the highest since late 2007, and far above the 10-year at 3.11%. An inversion is considered by many to be a reliable signal of a looming recession. And yields also dropped across Europe. European Central Bank board member Isabel Schnabel added to market unease by warning on Saturday that central banks risk losing public trust and must act forcibly to curb inflation, even if that drags their economies into a recession. The message from Jackson Hole was loud and clear and not what markets were expecting, said Nordea chief analyst Jan von Guerich. Central banks need convincing evidence that inflation is coming down. That is bad news for the economy and risk appetite and raises the risk of a deeper recession if we get more rapid rate hikes. Markets are focusing on discussing the message of coordinated tightening from Jackson Hole, as ECB and Fed appears to have recommitted to creating price stability. Yields are shooting higher and risk assets are quite a bit lower since last week, said a senior analyst at Danske Bank. As investors hunkered down for front-loaded rate hikes, key gauges of equity market volatility shot up. The volatility index, widely dubbed the Wall Street's fear gauge, rose to its highest since mid-July, and the Euro Stoxx Volatility Index, the European equivalent, jumped to its highest level in 6 weeks. Chair Powell and the Fed made it crystal clear that their job fighting inflation remains unfinished, said researchers at Morgan Stanley in a note to clients. The path for stocks from here will be determined by earnings, where we will see material downside. The aggressive chorus from central banks lifted short-term yields globally, while further inverting the Treasury yield curve as investors priced in an eventual economic downturn. All this benefited the safe haven dollar, which briefly shot up to a fresh 2-decade peak of 109.48 against the basket of major currencies. The dollar hit a 5-week high on the yen and was last up 0.8% at 138.72, with bulls looking to retest its July top of 139.38. Sterling sank to a 2.5-year low, around 1.1649, as Goldman Sachs warned Britain was heading for recession, and the euro dropped as low as 0.99145, not far from last week's two-decade trough of 0.99005, but it was just up a little more recently. The Dutch September gas delivery contract dropped as much as 11%, as Germany's economy minister said he expected prices to fall soon as Germany is making progress on its storage targets, with facilities nearly 83% full and set to hit its 85% October 1 goal in early September. Supply fears pushed natural gas futures in Europe 38% higher last week, adding further fuel to the inflation bonfire as a 3-day halt to Russian natural gas supplies through its main pipeline to Europe will start on Wednesday. German benchmark power prices, meanwhile, breached €1,000 per megawatt hour for the first time on Monday. I struggle to understand the sense of sharp ECB interest rate hikes. The big problem is energy supply, and right now it doesn't look like we can get out anytime soon, said Carlo Franchi, head of institutional clients at Banca Ifigest in Milan. Such a sharp rise in such a complicated economic picture will put companies and households in a very difficult situation. Trading volumes are really thin. I think it would be worth selling into any rally, even though the word rally doesn't seem appropriate. The rise of the dollar and yields has depressed gold, which was last flat at $1,737 an ounce. Yet, there are still some out there arguing that Friday's sell-off was frankly overdone. I know Powell, he said, is going to play tough with inflation, but it is honestly not that much different from what he'd been saying for the last several weeks. He was a little more hawkish, but I mean, geez, who is surprised by that, really? Said Randy Frederick, Vice President of Trading and Derivatives for Charles Schwab. I don't see a whole lot of up or downside from here in the near term. I see a lot of volatility, and that is probably going to be the case at the very least until we get past the September 21 rate hike, he said. But others disagree, actually. The Fed chairman last week sounded really hawkish, and that pretty much torpedoed the notion of a policy pivot early next year, said Joe Manimbo, senior market analyst at Convera. Central banks have no interest in being anything but hawkish right now, given inflation, so they will hike rates aggressively, said Nordea chief analyst Jan von Gurik. In cryptocurrencies, Bitcoin edged higher to trade back just above $20,000, and oil prices settled up by more than 4% on Monday, extending last week's gains as potential OPEC Plus output cuts and conflict in Libya helped to offset a strong US dollar and a dire outlook for US growth. OPEC Plus, comprising OPEC, Russia and allied producers, meet to set policy on September the 5th. Brent crude settled at 105.09, having risen by 4.4% last week, and US West Texas Intermediate gained 4.2% to 97.01 after rallying 2.5% last week. Oil prices are inching higher on hopes of production cut from OPEC and its allies to restore market balance in response to the revival of Iran's nuclear deal, said the vice president at commodity research at Religare Broking. Nations that are members of the International Energy Agency could release more oil from strategic petroleum reserves if they find it necessary when the current scheme expires, the head of the agency said on Monday. While a strong dollar restrains broad commodity prices, the undersupply issue in the oil markets will probably continue to support the upside bias, said CMC Markets trader Tina Teng. Unrest in Libya's capital at the weekend, resulting in 32 deaths, sparked concern that the country could slide into a full-blown conflict and disrupt oil supplies from that OPEC nation. US crude oil stockpiles likely fell around 600,000 barrels, with distillates and gasoline inventories also seen down, according to some preliminary research. Crude inventory in the US emergency reserves fell by 3.1 million barrels in the week of August 26, to the lowest since December 1984, according to data from the Department of Energy. So I guess the point from today's discussion is this, that whilst there are still some out there holding out against what the Fed has been saying and the other central bankers, the truth is that rates will go higher. They will do some more economy crushing, and that means that businesses and households are going to find it very troublesome ahead. And even the prospect of higher oil prices and the trouble with the gas system and gas prices won't be sufficient to deter them. Expect a recession to come. Expect markets to fall. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.